Okay, so we're going to do an introduction to the master budget. And when we talk about budgeting, what we're talking about is perhaps the most widely used management accounting tool employed by companies, organizations, and governments throughout the world. Even individuals such as yourself and I can benefit from creating a personal budget that shows how we plan to use our resources and to make sure our spending doesn't get out of control. A budget is a plan that covers a specific period of time. It's one that helps management determine how best to use its resources, both materials and manpower. And management can then estimate future costs and revenues. Management uses budgeting to express its plans and to assess how well it's doing in reaching its goals. So, budgeting assists in planning, acting, controlling, and developing strategy. Companies' strategies lead to detailed plans, which in turn lead to actions. Results are then compared to the budget to provide managers feedback. This feedback allows managers to take corrective actions and, if necessary, revise strategies, which starts the cycle all over. Specifically, budgeting is an ongoing process, creating long-term goals, setting key strategies for attainable goals, putting plans into action, and analyzing the results and taking necessary corrective actions. Now, operating budgets ordinarily cover a 1-year period corresponding to the company's fiscal year, which you can see here. Many companies divide their annual budget into 4 quarters. In this chapter, we focus on 1-year operating budgets. A continuous or perpetual budget is a 12-month budget that rolls forward 1 month or 1 quarter as the month or the quarter is completed. So they always have at least a focus of 1 year ahead. Responsibility accounting system enables management to react quickly to deviations from their plans and to learn from feedback obtained by comparing budgeted goals to actual results. A self-imposed or participated budget is a budget that's prepared with the full cooperation and participation of managers at all levels. It's particularly useful if the budget will be used to evaluate management performance. The advantages of a participated budget are as follows. Individuals at all levels of the organization are viewed as members of the team whose judgments are valued by top management. Budget estimates prepared by frontline managers are often more accurate than estimates prepared by managers, especially since you're dealing with those who are down in the trenches. Motivation is generally higher when individuals participate in setting their own goals than when the goals are imposed from above. So if we have some buy-in, we're more likely to try and achieve them. And a manager who's not able to make a budget imposed from above can claim that it was unrealistic, whereas self-imposed budgets eliminate this excuse. So you can't say, oh, home office gave me this huge goal and there's no way that I'll ever be able to reach it if you have some input into setting that budget. Now, the disadvantages of participating budgeting is that it can be time-consuming and costly. There's also some gaming in the system called budgetary slack. So that's where managers intentionally underestimate budgeted revenues or overestimate expenses so their budgeted goals are easier. There's also some budgeting issues which we'll mention here. It depends on 3 important factors. So top management must be enthusiastic and committed to the budgeting process. Top managers must also not use the budget to pressure employees or blame them when something goes wrong. Sometimes, too, highly achievable budget targets are usually preferred when managers are rewarded based on meeting budgeted targets. Now, the starting point for developing the budgets. The prior year's budgeted figures are actual results, or something called zero-based budgeting. So many companies use the prior year's budgeted figures or actual results as a starting point for creating the budget for the coming year. The prior year's figures are modified to reflect new product changes, customers, geographic areas, changes in the marketplace, changes in labor contracts, raw materials, fuel costs, inflation, or new strategies. However, this approach to budgeting may cause year-to-year increases that sort of grow over time and get a little out of control. When a company implements zero-based budgeting, all managers begin with a budget of zero and must justify every dollar they put in the budget. This budgeting approach is very time-consuming and labor-intensive. Therefore, companies only use it from time to time in order to keep their expenses in check. Here's an example of what the budget, a master budget, consists of. So this will be the set of budgeted financial statements and other supporting schedules for the entire organization. And you can see it's got quite a few budgets. We've got a sales budget, which drives our production budget, which drives the direct materials, direct labor, and manufacturing overhead budget, which again then filters down into our selling and administrative expense, and ultimately our budgeted income statement. Now you can see our financial budgets down here: cash expenditure budget, the cash budget, and the budgeted balance sheet.